Hello everyone. Welcome you all to session 3 of Banking and Financial Services class. I am Impa Villiyappa, Associate Professor, Department of Management Sciences, Maharaja Institute of Technology, Mysore. In my previous class, you have got an insight of the functions of commercial bank. We are in Unit 1, which tells you about the structure of Indian banking industry, and also we have discussed the functions of RBI. And in the previous class, we have discussed the functions of commercial bank. The functions of commercial banks are divided into two categories, that is primary function and secondary function. In the primary function, we discussed to the initial, the primary function again was divided into two concepts, that is deposit and advances. In deposit, we discussed savings deposit, fixed deposit, current deposit, recurring deposit, and also in advances we discussed overdraft, cash credit, loans, and discounting of bills. And also the secondary functions are divided into two different things, that is the agency function and the utility functions. In agency function, we discussed about the transfer of funds, the periodical payments, the periodical collections, and also we discussed about the portfolio management, collection of checks, and other agency functions. And in utility functions, we discussed about the drafts, lockers, letter of credit, underwriting, and project reports, and social welfare activities, and other utility functions. Agency functions which will generate profit for the banks, and utility functions is provided as the services from the banks to the customers. In today's class, we will be discussing two concepts, that is the monetary system and the sources of funds. To begin with the monetary system, let's know what is the meaning of monetary system. Monetary system are the policies and instruments employed by a country to regulate its monetary supply, that is money supply. In physical form, if you have to say about the money supply, it includes the banknotes, coins, and other things which is traded in exchange. Where in denomination, if you have to say, then we coin that monetary unit as rupees, dollar, pound, we name it as such. This depends on the total size of the money supply and also the basic policy rules. This monetary system of the country, that is of India, is controlled by the central bank, which is the RBI, where it uses a number of techniques to regulate the supply of money and its interest rates. Let's go forward. To continue with, we have the key internal features of the present monetary system, and also we have the external features, like it is segregated into two different categories, where we have internal features and external features. Coming with the internal features of the present, that is India's present monetary system, is divided into four categories. The first category is the unit of money. The unit of money in India, it is Indian rupees, where it is a medium. It is not only a medium of exchange, but also it is a unit which facilitates accounting. We can exchange goods or money worth for that unit of money, and also you can avail the accounting facility. You can track the account by using the unit of money. As the unit of account, the rupee helps us to estimate the cost and price, and also the revenue of the firms. If you have to measure what is the profit of the firm, what is the cost of the firm, then this is an unit through which you can measure the cost of a project, cost of the asset, cost of a good, or cost of a product. And this and also the gross national product can also be assessed with this unit of money. In India, the rupee is the monetary unit of account, which is based on the decimal system, and also it is from the Devagiri script, where it represents R format or capital R format, where you have the R format and two lines on top of it. So this is the rupee symbol. So here again, to continue with the second, we discuss about the monetary standard. In monetary standard, the present monetary standard of India is managed by the paper currency. so which you all are familiar and you regularly use on a day-to-day basis. And according to this paper currency which is in circulation, this is non-convertible into gold. This cannot be converted into gold. And also the paper standard which we use, that is the notes and coins, these are all managed by the Reserve Bank of India and also by the Government of India, that is the Ministry of Finance. And Indian currency notes, it is made up of from the pulp of the cotton and balsam. Balsam is an is fragrance extract which you get it from a plant, which is used with special dyes to make this currency notes. And Mysore also has an plant or a manufacturing unit where it prints the currencies. This makes the currency note durable, reliable, and to maintain its quality from resistance of wear and tear. Okay. Continuing with the monetary standards. Monetary standards means it is the set of rules and regulations and institutions that control the supply of money within the country's economy. So, if you have to have a balanced economy without any destroying of the content, then you have to have a balanced economy. To have a balance of economy, maintaining this monetary standard is very important. If you have to see the definition of monetary standard, it is the principal way of regulating the quantity of money in the market as well as its exchange value. So, what does it do? The monetary standard lays principle to regulate the quantity of money which is being printed and circulated in the country, that is in the market, as well as its exchange rates with different other foreign countries. The idea to have these rules and regulation in place is to constrain the production and supply of money. So, the rules and regulations are laid so that the movement, that is the purchase or the sale or of foreign exchange or the circulation of money within the country, to control that, to restrict that, to constrain that, to fix it to a place and to have a balanced economy. Because if we don't have a balanced economy, it will destroy our economy indirectly with the effects on the prices of the economy. So, the monetary standard helps you to have a balanced economy. So, when we discuss the types of monetary standards, there are two types of monetary standards. One is the metallic standard and another one is the paper standard. So, metallic standard, you can take the example of coins. Okay, this metallic standard are divided into two categories. Again, there are two types, where the metallic standard types, the first type is monometallism, which means there will be only one single metal, that is either it will be gold or either it will be silver, or any one metal is used to make the coins. That is known as the monometallism standard, that is monetary standard. The second one is paper standard. So, here we have already discussed about the monometallism, that is the first type. The second type in the metallic standard is the bimetallism. Bimetallism means where two metals are mixed to make a coin, that it might be a combination of gold and silver or it might be combination of any other two metals which will make the bimetallism. Next comes the types of coins and notes. So, types of coins and notes. Types of coins and notes here, it also includes the different coins and currency notes. In this, let's discuss the coins first. The rupee coin in India is the standard token of coin through which the intrinsic value of the metal is less than the face value. So, here normally the intrinsic value will be less than the will be more than the face value, but when it comes to the concept of coins, here the intrinsic value of the metal is less than the face value, because the worth of, if you melt a coin, you will not get anything. It's not even worth of rupee 1. Okay, so they say the intrinsic value is less than the face value. So, and also the rupee coins which you use, it is unlimited legal tender. You can trade with unlimited amount of coins to buy something. There is no restriction on that. And 2 rupee coin, 5 rupees coin, which we use in today's time, and 1 rupee coin. This was introduced and circulated since 1990. And to continue with the second one in the types of coins and notes, second is the subsidiary coins. Subsidiary coins are the coins which used to assist the token of money. For example, you have 1 paisa coin, 3 paisa, 5 paisa, 10 paisa, 20 paisa, 50 paisa, 25 paisa coin, which is in circulation. And 50 paisa coin is the unlimited legal tender, whereas 1 paisa and all, it is only up to 1 paisa, 25, 1 paisa to 25 paisa. It is only up to rupees 25 you can buy something by giving these coins. But as of now, there is no circulation of these coins. But one thing which is interesting is the government has not banned its circulation. It can be circulated, but unless the public willingly wants to stop the circulation. Now, as you all know, the public has stopped the circulation of these 1 paisa, 2 paisa, 3 paisa, 5 paisa, 10 paisa, 20 paisa, 25 paisa, 50 paisa. The circulation is stopped by the public, and this is not in motion. We normally use 1 rupee, 2 rupee, 5 rupee coins for the 10. And third one is the notes and paper currencies, which also relates to the second one, that is the monetary standard, where we have paper standard. Paper standard and this note and paper currency, it is one and the same. So I didn't explain there, I'll explain here. So paper currency in India consists of notes of various denomination, like 100 rupees, then you have 200 rupees, then you have 50 rupees, 20 rupees, 10 rupees notes, then you have 500 rupees, you have 2000 rupees note. So that those are various colorful notes in our country: purple, orange, blue. You have a wide range, and these denominations are decided by RBI and the government of India. And the coins are the 1 rupee coins are printed by the government of India, and it bears the signature of the secretary. The highest denomination ever printed in India by the Reserve Bank is the 10,000 note, which was in the year 1938 and again in 1954, and the notes were demonetized in 1946 and again in 1978. And you all know about the demonetization which happened recently, which took off the notes of 500 and 1000 and printed new notes of 500, 100, 200 and 2000. Coming to the fourth system under the types of coins and notes, the fourth system is the system of note issue. So how is it being issued in the country? The present system of note issued is concentrated on minimum reserve system. So as you all know, there should be a statutory minimum reserve of gold and foreign currencies in RBI, which accordingly RBI has around 2,200 crores, where 115 crores is like the gold and 85 crores is like foreign security. And to give you the exact statistics, the RBI total gold reserve is 612.56 tons in the preceding fiscal year, which ended in 2019. An addition of 40.45 tons of gold has been raised to the value of gold reserve to 30.57 billion by March 2020. From these are all in dollars. $23.07 billion in March 2009. So earlier it was $23.07 billion in March 2009, which rose up to $30.57 billion in March in the current year. The share of gold in the total foreign exchange reserve rose from, which was 5.59% as of March 2019, which rose up to 6.40% in March 2020. The Indian forex includes if you have, we say no, that gold you know easily, whereas foreign exchange you have to keep the foreign securities as reserve. This includes the foreign currency assets, gold reserve, special drawing rights, and also reserve position with the international, that is IMF, International Monetary Fund. So around 360.71 tons of gold is held overseas in safe custody with the Bank of England and the Bank of International Settlement, while the remaining gold is held domestically. Okay, and the fourth point under the internal factors, which is the money supply. So this is an important question for your exam. So let's know what is money supply first. The total stock of money which is in circulation among the public at a particular point of time is called as money supply. So whatever money is being circulated within the country at a particular period or particular duration of time, that we call it as money supply. And in India, the money supply is measured in 4 categories, that is M1, M2, M3 and M4, and along with it you have also M0. That I'll tell you what are these at in the next coming next. Okay, this classification was introduced in April 1977 by RBI. According to the type and size of account in which the instrument is kept, based on that this segregations is made. What are these segregations? I'll tell you. And the money supply is all the currencies and other liquid instruments in the country's economy on the date measured, which I've already told you. During a specific time, it might be the currency or any liquid instrument which comes under this category. The money supply includes both cash and deposits that has to be used, that can be easily converted into cash. Coming to the measures of money supply, I told you about the M0, M1, M2, M3, M4. Let's know what are these. To begin with M0, it is called the reserve money or base money or monetary base, which is the monetary base of the economy. It is also known as the high powered money. And to include this M0, if you have to call this M0, what is it called is the current, it includes the currency in circulation, the cash in hand and the bankers deposits with RBI, which is nothing but the CRR, where I have told you about this, where the different banks keep a reserve in RBI, that is different commercial banks keep a certain percentage of amount in RBI, that is called CRR. In detail, we will learn it in the next concept, where M0 includes this currency in circulation, cash in hand, bankers deposits with RBI and also other deposits with RBI. This is about M0. The second one is M1. So M1 means it is narrow money. Narrow money includes currency with public, that is which includes that is a cash in hand and circulation, plus demand deposits with banking system. Demand deposits, I have told you in my previous class about the current deposits, saving deposits and fixed deposits. That is nothing but the demand deposits with the fixed deposit is not there, sorry, current deposit and saving deposit. This is demand deposit. So that whenever the customers demand for money, immediately it has to be given. Okay, that is demand deposit and other deposits with RBI. Okay, these three are the components of M1. Next is M2. M2 includes M1 plus savings deposits of post office savings banks. So in savings banks, whatever the post office savings we make it, including that plus M1 combinedly, we call it as M2. Coming to the next category, broad money. Broad money is M3. M3 includes M1 plus time deposits with the banking system. Time deposits are nothing but the fixed deposits where it matures after a fixed period. That we call it as time deposits. So M3 includes M1 plus time deposits. And the last one is M4. M4 is a combination of M3, which is M1 plus time deposits plus all the deposits of post office savings. So this is like a combination. Okay, M4 includes M3 plus all the time deposits. To compile it, M0 is currency in circulation plus cash in hand plus bankers deposit plus other deposits. M1, that is M0. M1 includes currency with public demand deposits and other deposits. M2 includes M1 plus post office savings. M3 includes M1 plus time deposits. M4 includes M3 plus all the deposits in post office savings. These are the four internal features of monetary system. Coming to the external features. External features are divided into three categories, that is foreign exchange rate, exchange control and foreign exchange reserve. Let's begin with the first one, which is foreign exchange rate. Since January 1976, with the signing of the Jamaican Agreement, the India following the policy of floating exchange rates. Okay, that is different exchange rates for different periods. According to this, all the external value of the Indian rupee is linked to a basket, which is including the currency of those countries with which India trades frequently. And the weighted, this is called as a nominal effective exchange rate of rupees, which has a weighted average of exchange rate vis-a-vis the currency of major Indian traders, that is trading partners. Up to February 1993, India followed a dual exchange rate regime where RBI fixed an exchange rate in terms of various currencies such as dollar, pound, yen, franc from time to time for the legal exchange of transactions, which took place announcing the official rates. And in March 1993, India moved to single market determined exchange rate system. Under this, there was no official fixed rate was fixed for the rupee. Instead, exchange rate they were determined by the demand and supply conditions of the foreign exchange market. RBI intervenes only to the maintenance orderly market conditions to curb the excessive speculations. So, before going to the second one, so as of currently, we follow the floating exchange rate system. Continuing with the second one, the second external feature of monetary system is exchange control. In the exchange control, to have a control of these exchange rate, RBI controls all the foreign receipts and payments made in terms of foreign currencies. And there is an exchange control department for this purpose to take the receipts and make the payments in forms of foreign currencies. And foreign currencies coming into India are required to be sold and exchanged for rupee either directly to RBI or they have authorized dealers. Their authorized dealers are none but the commercial banks, hotels, firms, shops, where you can deal with foreign currencies or travelers checks. About the foreign currencies and travelers check, I have told you in my previous class. And they also are the authorized lenders and borrowers of foreign exchange currency among themselves, that is within the banks, that is interbank market locally. The actual lending limit for these authorized dealers are fixed by RBI depending on the size of operations and other relevant factors which will influence to fix the size of the exchange. In March 1992, the RBI introduced the partial convertibility of rupees, which was in the ratio of 60 and 40, and liberalized the exchange rate management system, which we short formly call as LERMS. Under this system, all the foreign exchange receipts on current account transactions, exports, remittances, all were required to be surrendered to the authorized dealers in full. In March 1994, full convertibility of rupee. In 1992, they made partial convertibility in the ratio of 60 and 40, wherein March 1994, full convertibility of rupees on the entire current account transactions were introduced. Consequently, the RBI announced certain relaxations in the exchange control to a specific limit on the studying abroad, gift remittances, donations, basic travel quota, then exchange earning from foreign currency accounts, export oriented units, payment of certain services to be rendered by other parties. All these fields were given relaxation in March 1994 for the purpose of fully convertibility of the rupees. This is about the exchange control. Coming to the third one, which is foreign exchange reserve. The third external factor is foreign exchange reserve. Foreign exchange reserve means the RBI show a quantity of foreign currencies which can be utilized for the country's trade and foreign transaction. The variation in the foreign exchange reserve also show the balance of payment position in the country. So if you have to know the balance of payment position in the country, then if you have to rely on the foreign exchange reserve. This comprises of the foreign exchange assets of RBI, gold held by it, and SDR balances. These three in combination comes up with the foreign exchange reserve. And the monetary system which we are discussing about includes the monetary policy. You have heard about the monetary policy, you will be knowing about the monetary policy. So what is this monetary policy? So monetary policy is a process in which the monetary authority of the country, generally the central control of the supply of money in the economy by its control over the interest rate in order to maintain the price stability and achieve high economic growth. So what do you mean by a monetary policy? It's an authority, it's a monetary authority of the country which generally controls the central bank and controls the supply of money in the economy and also controls the interest rates in order to maintain the price stability. Okay, it also helps to achieve economic growth. So let's see what are the objectives of this monetary policy. The first objective of this monetary policy is price stability. See, in the meaning or definition which I told you, all the objectives are present there itself. The price stability is the important objective. So price stability means promoting of economic development with considerable emphasis on price stability. It enables development projects. Means whenever you say about the price stability, if you have to keep the price in a constant stage, it has to be stable. If there are lots of fluctuations and variations, you won't get proper investment for the corporate sector. So this helps in development projects. Coming to the second objective, controlled expansion of banks. So accordingly, if you have a seasonal requirement of credit, if you need credit during the seasons, all the time it will be constant. But in certain situations, like just like COVID, you need excess cash, you need more credit. If you have to generate more credit without affecting the output, and this helps you. The monetary policy helps you to cope with these kinds of situations. The third objective is promotion of fixed investment. The aim here is to increase the productivity of investment by restraining the non-essential fixed investment. So rather than keeping it fixed in some place, it's you promote it and use it for the increment of the productivity by circulating. That is the thing which monetary policy does. And next is restriction of inventories and stock. So rather than piling off or overfilling the stocks and products, which becomes outdated and you cannot easily convert it into cash, you'll keep the excess stock, which will lead to the sickness of the unit. To avoid this problem, Central Monetary Authority carries out this essential function of restricting the inventories in order to avoid overstocking and idle money piling up. The next objective is promoting efficiency. So promoting efficiency means where you can know about the financial system. It tries to incorporate structural changes such as deregulation of interest rates, easy operation constraints in the credit delivery system, and also introducing new money market instrument. So if you want to introduce new money market instruments, or if you have to have an easy operation, if you have to deregulate the interest rates, anything you want to do about it so that the efficiency is increased, then monetary policy, which is done every year, will help you out to reframe it. The last one is reducing rigidity. Reducing rigidity means it maintains its control over the financial system wherever and whenever it is necessary to maintain. Its discipline, its operations, all are maintained by one authority, which is none between but RBI. So, which is more, it keeps in such an autonomy, considerable autonomy, where there is flexibility for its operations. So, these are some of the important objectives of the monetary policy. So, coming on to the next concept, which is sources of funds. So, sources of funds means from what all sources will the bank get the fund. Okay, to know that, there are three main headings of sources of funds, which is the capital, which includes paid up capital and reserves. Then comes the deposits, which includes, which we have already discussed, that is current deposit, fixed deposit, savings deposit and recurring deposit. Then comes the borrowings. In borrowings, we have borrowings from the central bank, borrowings from the interbank, and borrowing from call money, and borrowing from repurchase agreements. So, these are the different borrowing tools through which the banks will get its fund in order to disburse it to the public. To begin with, let's start with the first one, which is the capital. So, what do you mean by capital? The bank capital represents the net worth of the bank and its value to the investors. So, whatever fund it's getting, that the initial fund, that we call it as the capital. And this capital is divided into two categories: primary capital and secondary capital. What do you mean by primary capital? Primary capital is issuing of common stocks, preferred stocks or equity stocks to the primary, in the primary market or secondary market. So, initially when the banks go for a public issue, they issue shares for the first time and then it is traded in the secondary market. Any cash coming in this source, we call it as primary capital. Secondary capital is resulting from the issue of notes and bonds, subordinate notes and bonds. When you issue that, comes up to secondary capital. And capital can also be categorized into paid up capital and reserves. So, you have from your PU, you have learnt about the authorized capital, subscribed capital, paid up capital, called up capital. You have known about it. So, authorized capital is the maximum amount of capital which can be issued by the company or the bank throughout its lifetime, unless there is a change made in the articles of association, that is known as the authorized capital. Then comes the subscribed capital, where initially the shares are issued for a part of the subscribed capital. For the subscribed part capital is a part of the authorized capital. So, here subscribed capital means the shares, the capital to which the shares are issued. So, paid up capital, what do you mean by paid up capital? Paid up capital is a portion of subscribed capital, which in turn subscribed capital is a portion of authorized capital. Here, paid up capital indicates the contribution made by the shareholders to the bank, means they have already paid some portion of money which they have already subscribed. So, paid up capital is a portion of subscribed capital. If I have to tell you the definition about it, it's a part of the subscribed capital which has to be called up and paid, while subscribed capital is a part of the authorized capital which has been issued to take up to the public, including shares to and paid by the sponsors. So, here in a simplifying way, paid up capital is the capital which is being called by the banks for the payment. So, called up capital means the bank have called for the funds, whereas paid up capital means the sponsors or people or public have paid it to the bank. That is known as the paid up capital. And next is reserve fund. So the reserve fund is an amount accumulated over certain years, which is an undistributed profit. If you have not distributed the profit among the shareholders, then that will accumulate in the reserve fund, and it belongs to the shareholders. But at times of need, when there is conditions where there is no stability, where there is no growth in the bank, where there is financial losses from time to time, to cover those, the fund can be drawn. And the fund also operates as an additional security to the bank's customers. So there is no chances of loss, there is no chances of cheating. If the reserve fund is there, anything happens to the bank, at least the customer's amount will be safe. Okay, it's an accumulated of retained reserves of their essential condition. Like if the bank's condition, financial condition is good, if it's financially sound, if it's stable, and there is always growth in the banks, then they'll have more profits. If they have more profits, then that profits will be divided among the shareholders. A part of profit is divided among the shareholders, and remaining part of shareholders are kept for the purpose of the customer's safety. That is nothing but the reserve. Coming to the next sources of funds, which is deposits. In my previous class, I have told you about the 4 types of deposits, which is the savings deposit, current deposits, fixed deposit, and recurring deposits. To start with the meaning of deposits, deposits are very important for the banks because 90% of the total fund is generated from deposits. It is accounted from deposits. And the funds are liabilities of the bank. Whenever it is demanded from the customers, they have to pay back to the customers. That is, they have to return it to the customers. So they have certain deposit schemes. They also have fixed deposit schemes, because these amount can be used for a longer duration of time, because that will be generated only after the expiry of the time. But savings account, current account, these deposits cannot be used for a longer duration of time, because it has to be given to the customers whenever the needs and interests of the customer arise and they demand for it. This includes your current account. I've told you about it, but even then, current account has very low interest rate, and the deposits are called demand deposits, and whenever people demand for it, you need to give them back. It is suitable for traders and big businessmen, and overdraft facility is available in this. Payment is also unlimited, acceptance is also unlimited, because in business, you know the uncertainty. Sometimes the deposits will be more, sometimes the payments will be more. So only the overdraft facility is given. That is about the current account. To tell you about the fixed account, then interest rate is high, whereas the period will be fixed. After the expiry only they give the money back, or else there will be changes in the interest rate, and it will be lump sum payment made in advance, fixed. Okay, and it is more than 1 year. And then comes the savings deposit. Savings deposit includes you draw, you have specific limit once in a day, certain percentage, certain amount is fixed. That differs from bank to bank. Interest rate is low in savings account. It is mainly suitable for salaried people, where they get regular incomes and regular fixed incomes. And then is recurring deposit, where small amount of periodical investment is made, and the interest rate is comparatively high to savings account. This is about the deposits. And the last one, which is the borrowings. In borrowings are from the central banks, other banks, which is a source of raising the fund for the commercial banks. In case of emergencies, where their bank lose their money and they run out of the funds, then they can use the facility given for borrowing it from central bank and other banking institutions. So whenever the banks are unable to meet their regular commitments, then they can use these. So to start this, Borrowing from central bank. So borrowing from central bank, I told you about this, rediscounting of purchases on the eligible bills, loans and advances against certain securities. The commercial banks can approach RBI, which is our country's central bank, and take loan or borrow money from RBI for their daily needs or daily emergencies or contingencies. And next is borrowing from interbank. So borrowing from interbank means one bank borrows it from another bank at an interbank rate. So sometimes it is for overnight also. Then it is called overnight rate. Okay, this overnight rate or bank rate will on that rate the two banks have this transaction where one bank borrows loan from the other banks. This includes interbank deposit sources, interbank call money, repurchase agreement. The third one is borrowing from international financial institutions. So I've skipped that as there is no space. So borrowing from international financial institutions, where if you are borrowing money from IMF, that is International Monetary Fund, or World Bank, or other affiliated bodies like Asian Development Bank or IDB or other foreign agencies and development partners. So through them also you can borrow money for your funds. Then call money. So call money is whenever you require the funds, you call that is, I've told you about the paid up capital, no, the shares which are not being paid. Then you can call for the remaining unpaid about, that is the first application money or second application money, whatever calls are pending, you can call that money. Then the public, you can borrow it from the public. That is one where you can call back the funds. And then repurchase agreement, I've told you, that is we also call as repo, where you repurchase the money from the RBI. Okay, so these are all the different sources of funds which we have discussed in today's class. To sum up with, in today's class we discussed about the monetary system and sources of funds. In monetary system, it is divided into two categories: internal and external features. The internal features of monetary system includes the unit of money, that is the rupee; monetary standard, that is the coins and paper currencies, that is metals and paper currencies. In metals it is monometallism, bimetallism, and paper currency standard it is common. Then you have types of coins and notes, where we discussed about the notes and coins which is circulated within the country. Then we discussed about the money supply, that is M0, M1, M2, M3 and M4. Then in the external features, we discussed about the foreign exchange rate, how it is determined, that is floating exchange rate and based on demand and supply. Exchange control, that is a separate exchange control department is there which regulates everything. Then foreign exchange reserve, a specific reserve for the purpose. Then we discussed the monetary policy, what are the objectives of monetary policy and why monetary policy is important to be framed in the country to have basic price stability. And then we have sources of funds, where we discussed about the capital which can be generated through paid up capital and reserve. Then we discussed about the deposits, where we discussed the current deposit and savings deposit, recurring deposit and fixed deposit. Then we discussed about the borrowings, where we discussed about the central bank, interbank, call money and repo rates. Okay, these are all a part of the central and interbank. This hope in today's class you have understood about the monetary system and sources of funds. Thank you.